What if I told you that becoming a successful investor doesn't require an Ivy League degree, insider tips, or even a bit of luck? Instead, it comes down to a surprisingly simple formula, one that's more about mindset and strategy than about crunching numbers. In Benjamin Graham's legendary book, The Intelligent Investor, he outlines the principles that can help anyone build wealth in the stock market without needing to become a Wall Street expert. These timeless lessons have guided some of the world's most successful investors, including Warren Buffett, who calls this book the best book on investing ever written. Stick around to uncover Graham's wisdom and learn how his approach can provide stability in today's unpredictable market. Plus, stay tuned for a powerful tip at the end that could transform how you think about risk and reward. But first, if you're new here, make sure to hit that subscribe button. We're here to support your journey to smarter investing and financial independence. Every week, we share insights, strategies, and tools to help you become more financially savvy. Takeaway 1. Meet Mr. Market, your unpredictable business partner. Imagine this. You own part of a business worth about $1,000. Now, every day, a quirky partner named Mr. Market shows up, offering to either buy your share or sell you more of his at wildly different prices. One day, he values it at $2,500, and the next day, he slashes it to just $500, seemingly based on his mood rather than any rational assessment of the business. Sounds a bit ridiculous, right? This character, Mr. Market, is one of the most memorable concepts from The Intelligent Investor. Graham uses Mr. Market as a metaphor for the stock market's unpredictable swings, illustrating that market prices often reflect emotional highs and lows rather than an asset's actual value. This teaches us something crucial. Successful investing is not about reacting to every twist and turn, but understanding the true value of what we own. Managing emotions in investing. In Graham's time, investors only received price updates once a day in the morning newspaper, so Mr. Market's mood swings were somewhat limited. But today, we're bombarded with updates every second through our phones and laptops. This constant feed can lead to a lot of anxiety, encouraging many of us to overreact to short-term price movements. Graham's advice? You don't have to engage with Mr. Market every day, or even every month. Instead, be selective about when you respond to his offers, focusing only on those that align with the real value of your investments. So here's an open-ended question for you. Next time the market takes a hit, will you respond with fear or see it as a potential buying opportunity? Let's dive into the next key takeaway to understand how you can navigate this with ease. Takeaway 2, the defensive investor's simple strategies for steady growth. Graham believes investors generally fall into one of two categories, the defensive or passive investor and the enterprising or active investor. The defensive investor prioritizes safety and consistency, focusing on strategies that minimize risk rather than maximizing returns. If that sounds like you, Graham recommends building a diversified portfolio split between bonds and stocks, perhaps a 50-50 balance, and rebalancing it once or twice a year. The defensive investor can benefit greatly from a simple method called dollar-cost averaging. This involves investing a fixed amount regularly, for example, right after each paycheck. This practice helps you avoid the pitfalls of trying to time the market, as you're consistently investing whether prices are high or low. For a defensive investor, the real value lies in long-term consistency, not quick wins. Dollar-cost averaging also helps build a habit of investing without getting distracted by the latest trends or market fluctuations, giving you a steady, reliable growth trajectory. The peace of mind this brings is invaluable. Setting up your own dollar-cost averaging. If you're ready to get started as a defensive investor, here's a challenge. Set up an automatic monthly investment, even if it's a small amount. This routine will help you understand how consistent investing can simplify your financial journey and reduce the emotional ups and downs of reacting to market volatility. Takeaway 3, the enterprising investor. Rewards for extra effort. If you're ready to go beyond basic strategies, welcome to the world of the enterprising investor. This approach demands more time, knowledge, and patience because it's about digging into undervalued stocks, spotting hidden gems, and making well-timed decisions based on in-depth research. Imagine it's the year 2000 and tech stocks are soaring. Everyone is buying into the dot-com bubble, convinced prices will only go up. But Graham would have cautioned against jumping into overvalued stocks. Instead, he'd encourage us to look for the undervalued stocks that may not be as glamorous, but represent solid, stable businesses with a low purchase price. For the enterprising investor, value investing becomes the game's name, focusing on stocks priced below their intrinsic worth. In fact, during Graham's career, he found that some stocks were priced so low they didn't even account for the company's net working capital. These are rare today, but they do occasionally appear, especially during economic downturns. If you have the time and passion to research, the enterprising approach could uncover excellent opportunities. Here's a question for you. Do you think you'd have the discipline to wait for the right opportunities, even if that means ignoring the market hype? Graham's own investment strategy in action. During the Great Depression, Graham was able to purchase stocks at rock-bottom prices, taking advantage of the widespread fear in the market. He used this approach to invest in companies that were selling for less than the value of their assets, a rare find today, but a concept that remains relevant. In doing so, Graham established one of the most successful investment careers of his time. This leads us to our next crucial lesson: the importance of maintaining a margin of safety when investing. Takeaway 4. Margin of safety, your protective cushion against market shocks. Even the best investors make mistakes. Market conditions change, predictions fall flat, and unexpected challenges arise. That's why Graham emphasizes the importance of having a margin of safety. Think of it as a cushion to absorb the shock of unexpected losses. Imagine you're designing a bridge. You'd want it to support more weight than it will regularly carry, right? The margin of safety is the same concept. If you value a stock at $30 per share, you should only buy it if it's available at a much lower price, say $20. This way, even if your valuation is off, you're still less likely to face significant losses. This principle is essential because it allows investors to withstand market downturns and ensures that even if things don't go perfectly, you're not losing out in a big way. So next time you're about to make an investment, ask yourself, are you buying it at a price low enough to give you that margin of safety? Misconceptions about risk and reward. Now, many of us have heard the saying, high risk, high reward, and it's true to an extent. However, Graham challenges this view, pointing out that you can often achieve excellent returns without taking on excessive risk if you're patient and disciplined. Takeaway 5. Rethinking risk and reward, they're not always linked. The academic theory suggests that higher returns come only when you accept higher risks. Graham, however, argues that this doesn't always hold up. In fact, if you're able to find undervalued assets and buy at the right time, you can get high returns with minimal risk. To illustrate, let's look at a scenario where you buy a business valued at $1 for only 60 cents. That's a lower risk investment because you're paying far less than the business is worth, increasing the likelihood of high returns. The art of intelligent investing lies in finding these undervalued opportunities where the risk is already mitigated by a bargain price. Consider this: how often do you evaluate potential investments based on their real value rather than following the crowd, blending defensive and enterprising strategies? Here's a tip for those of you who are still with me. You don't have to strictly choose between the defensive or enterprising investor approach. Many successful investors blend both. They maintain a solid defensive foundation, but set aside a small portion of their portfolio for enterprising investments. This strategy allows you to build stable, long-term wealth while giving you a taste of higher returns through selective, higher-risk investments. Recap: summing up Graham's lessons for intelligent investing. Let's quickly go over Graham's key strategies to becoming an intelligent investor. 1. Mr. Market. Don't let the market's daily mood swings control your decisions. Treat each price as an opportunity, not a command. 2. Defensive investing. Build a balanced portfolio using simple, low-risk methods like dollar-cost averaging to grow your wealth steadily. 3. Enterprising investing. If you have the dedication, seek undervalued stocks for higher returns. But remember, this requires more time and effort. 4th, margin of safety. Insist on a buffer to protect against losses, buying only when prices are low enough to offer security. 5. Rethinking risk and reward. High returns don't always require high risk. Instead, buy value at a discount and enjoy the best of both worlds. What do you think? Are these timeless lessons as relevant today as they were in Graham's time? Let us know your thoughts in the comments below. If you enjoyed today's breakdown of The Intelligent Investor by Benjamin Graham, then I think you'll love The Psychology of Money by Morgan Housel. This book explores the often overlooked psychological side of wealth and investing, revealing how our beliefs, biases, and behaviors shape our financial success. It's a perfect follow-up to Graham's strategies, providing insight into how we can become smarter, more emotionally aware investors. If you found this video helpful, don't forget to subscribe, give it a thumbs up, and leave a comment below. Let me know what your biggest takeaway was, or if there's another book you'd like to see covered. Your support helps us bring more valuable content to the channel. Thanks for watching, and I'll see you in the next video.